Hello and welcome to Big Deal. Now, new rules on foreign investments is a game changer. Many relaxations, simplifications and clarity given on how India can capture the global growth opportunities. Now, the key highlights in my view are the clearer round-tripping guidelines, lift to AIF investments in assets with no connection to India, portfolio investment opportunities even in unlisted entities overseas, and a big thrust given to the financial services investment opportunities by even non-financial services companies in India. Rules also open investment opportunities to be captured in IFSC by both companies as well as the individuals. Let's deep dive into the various aspects with our panel of experts today. Let me welcome on the show Dinesh Kanabar of Dhruva Advisors and Cyril Shroff of Cyril Amarchand Mangal Das. Gentlemen, welcome to CNBC-TV18. Cyril Shroff, set the stage for the discussion. Why was this really required and how big a change is it in your view?
So thanks very much for this, Nisha. And I think this conversation is very topical. And it's great that you're starting with the why, because I think that is the crux of trying to understand the rest of what is following the new ODI regime. I think the why is really about a kind of a confident, outward-looking India, both from a state point of view as well as from a private sector point of view. I think it is a big step in the journey of liberalization and ease of doing business, and a big migration towards a more trust-based progressive regulatory regime. And corporate India now is ready for bigger and more freedom in terms of having a global footprint. Not that it does not have already, but I think this gives it a very big fillip. And we'll talk about it more detail in the rest of the session.
Yes.
But some of the changes are very significant.
Yes.
And it's also a lot of small to medium-sized changes, which collectively, when you look at the whole package together, adds up to quite a lot. So there are a few sixers and lots of ones and twos as well.
Yes.
And the total, I think, is good. So just to take a few examples, firstly, there's a very clear definition of ODI and OPI.
Yes.
As you said in your opening remarks, there is more clarity on round tripping, which was earlier just part of an FAQ, but now there is a much clearer framework from the layering requirements point of view, and the absolute bar has been lifted and has been kind of made into a more streamlined framework. I think there is clarity in terms of deemed approval for so many things. After 45 days, if certain approvals don't come or it's not rejected, they're deemed to be approval. So it's all ease of doing business. I think there's clarity on deferred consideration.
Yes.
There is an interesting jewel out there. I don't know whether it was fully intentional or not. On swaps, they need not be only for against primary issuances. You could issue them against in exchange of securities, which need not be primary. It could be even from another company. So I think there's a lot of creativity which can be unleashed in this.
Yes.
Even the framework for guarantee for steps down subsidiaries has been clarified. It's a long list, and we can explore this in more detail.
So many technicalities have also come in, but broadly, some of the big highlights, let's focus on that and delve deep into it. Dinesh Kanabar, financial services investments overseas gets a big thrust by financial services as well as non-financial services entities in India.
Yes, Nisha, and again, thank you for having me on the show. I think it's very important. If I could just take half a minute to supplement what Cyril mentioned, I would break up all the changes into maybe three broad buckets. One is the big changes, including the financial services sector, which I'll speak about in a minute. And then you have certain things which are pure procedural impediments, which really created a bugbear. How do you write off foreign investments? Do you need RBI approval for everything? Doing away with many of those things. And then again, as Cyril mentioned, providing a mandatory approval if an approval was not granted within a time frame. But let's go to the financial services part, which you mentioned, which I think is among the biggest changes. So investment by financial services sector into financial services sector overseas, by and large, continues what it was earlier. You need a 3-year track record. You can invest in other than insurance and banking, and you need to get your regulatory approval both in India and overseas. So that regime by and large continues as it is, barring a few small changes which are not very critical. But I think the big important thing is that people who are in India, not into financial services, can make investment into financial services overseas. Now, that might look like a small thing, but the moment first is there is a definition of the term financial services. And the term financial services is defined to include any item which is regulated by a financial services regulator. So, for example, could one go back and say, this of course is a matter of interpretation which we will have to see over a period of time, that investments are today regulated because if you are making investments, you could be an NBFC, and NBFCs are regulated by the Reserve Bank of India. Now, could you as an industrial house make a subsidiary overseas which is making investments into many other companies? And if that is permitted as it appears from a plain reading of the provisions, that's a big thing opening up for the Indian industrial sector. Because then now you can say, yes, I want to make acquisition overseas. I will set up an SPV, of course, subject to the layering and all of those. But I can go ahead and make 400% of my investment because an investment company, an investment qualifies as a financial services. So a big thing. The second thing really is, again, you mentioned in the passing with regard to international financial services sector, which is, or the center, which is in the GIFT City. And again, in GIFT City, a specific permission that an entity which is not engaged in financial services can make investment into financial services sector in the GIFT City, even without there being a track record of profits. And again, as Cyril mentioned earlier, that you need, wherever you need a regulatory approval, and the regulatory approval has been applied for and does not come in 45 days, it is deemed to have been approved. So a big change, a very significant change, particularly with this interpretation that investment constitutes a financial services activity and one can make investment into an investing company overseas is appropriate, as it very much looks like.
That's right. You gave a full roundup, but one question on the financial services, which is a very meaty chunk of the new regulation. Cyril Shroff, non-financial services entities in India can invest in financial services assets overseas. And the question the industry is raising is that a manufacturing company, can it do the same? Do we have an answer? And what are the other aspects that you will watch out for, which will be a game changer in this respect?
So I think banking and insurance, I think, has been treated separately. Yes. Because that is carved out. But financial services now is such a broad canvas. For example, fintech. For example, there could be a number of cognate services in the financial services space. There's a gray area on whether investment activity should be treated as part of financial services. I think it could, but that might be an area for further clarification. So even if you leave out banking and insurance for a second, there is a whole new world which has got simplified and which has kind of, the doors have opened because of this change. And industrial conglomerates could be able to use this route for expanding their footprint, or tech companies, for example, because the boundaries between technology and finance are merging so fast. So this is actually opening not only a floodgate of opportunity, but also leveling the field, because there is a parallel conversation going on about whether global big tech companies should be allowed in the financial sector in India. So it is narrowing the discrepancy in the competing fields as well. So I think it's a step in the right direction. Whether we have crossed the whole chasm in one leap or not is to be debated, but it is certainly narrowing the gap.
Right. And another big highlight there, Dinesh Kanabar, and you may want to delve into it, is the AIFs getting a big boost because they can now invest in assets which have no connection to India. What is the scope of this widening of the gamut?
It's indeed, in fact, you again, a very important point, Nisha. Alternative investment funds earlier could, so first of all, any investment would constitute part of the OPI, which again, and again, if I could just step back here, Cyril earlier mentioned regarding better definition of ODI and OPI. So we now have unlisted entities clearly constituting OPI and having an ability to make OPI overseas, number one. And number two, AIF being able to make investment overseas where there is no connection required in India. Again, a very, very significant change, a very, very welcome change, Nisha.
That's right. Dinesh Kanabar, Cyril Shroff, hold on to your thoughts. Many other aspects to really discuss in this game-changing new regulations on foreign investments by Indian entities right after this short break on Big Deal. Stay tuned.
हिंदी, उर्दू, पंजाबी, भोजपुरी में
जीनियस। अच्छा, शहर कौन सा?
सही सवाल, गलत जगह। सही जगह है ग्लोब कैपिटल, जहां पर आपको मिलेंगे अवार्ड विनिंग रिसर्च बेस्ड आइडियाज, अपने पोर्टफोलियो को मैनेज करने की सुविधा। ग्लोब कैपिटल, मनी मस्ट ग्रो। इन्वेस्टमेंट इन सिक्योरिटीज मार्केट आर सब्जेक्ट टू मार्केट रिस्क। Read all the related documents carefully before investing.
Some folks dream of easy access to airport services. Some have ease of a card. Be it lounge access, meet and assist, spa services, and more. And what powers their credit and debit card is Dream Folks, India's largest airport services aggregator platform. Dream Folks.
नई कार खरीदने से पहले एको इंश्योरेंस कंपनी चेक करे और 50,000 तक बचाए।
From David to Goliath, from the smallest business ventures to multi-million-dollar global corporations, meet the movers and shakers, today's newsmakers, and tomorrow's leaders. Understand what makes markets move, how companies make quantum leaps, and how giant corporations stay ahead. Get the biggest business stories of the day, power-packed into 30 minutes on Business 360 at these times.
Welcome back. You're watching Big Deal, and we are discussing the scope of the new regulations on foreign investments. Dinesh Kanabar, you briefly touched upon round tripping. I want to focus a little more on that. The restrictions put on the two-layer system subsidiary, also under not under parent, under the foreign entity. So how feasible is the execution, and will it spur more cross-border transactions as well as more flow, easier, smoother flow of money from India overseas?
As Cyril mentioned in the passing earlier on, that really there were no regulations concerning round tripping. There were two simple provisions. One was the FAQ, where round tripping was sort of inverted to and was said as not permitted, number one. And number two, we had a situation on an interpretation that if there was an ODI and an FDI together with it, then that was regarded as not being a genuine business purpose because it constituted round tripping. That is how the entire concept of round tripping was sort of interpreted in practice. And there were a number of notices issued by Enforcement Directorate, and there were responses. And clearly, this was one big area where nobody knew what was the correct stand, etc. And everybody was worried about prosecution. I can also tell you, Nisha, that we have been dealing with practically a number of situations where transactions have not been consummated only because there was this fear of round tripping.
Yes.
We now have a specific provision to say that if there is an ODI accompanied by an FDI, that is absolutely permitted, subject to there being only two layers of subsidiary and no more. And I will come to that part earlier. But first and foremost, we are now looking at a situation where round tripping has been expressly blessed. There's a question, of course, which somebody posed to us the other day to say that could you actually set up a company overseas and that company has no activity but to make an investment in India? I would doubt whether that is practicable, because whether that's such an investment by India into an overseas ODI could be regarded as a genuine business investment would be very much in doubt. But clearly the overhang that we had, that if you made an investment overseas and that entity had, say, 10%, 20%, something in India, something was flowing at a later point of time, etc., you never really had to worry. I mean, the number of things lawyers and accountants have put creatively to sidestep round tripping is not even funny, and those things now maybe will be a thing of the past. Insofar as your question is concerned as to whether this is practicable, giving the layering which is not permitted, I would think that you can go to a multi-layer situation. All that is required is that you now need to go to Reserve Bank of India if you had, for example, 7 layers of subsidiary. And then the question is, why do those subsidiaries exist? What is happening out there is something that you need to explain to Reserve Bank of India. But once you have exorcised this ghost of round tripping, Reserve Bank should have really no objection to multiple layers, so long as it is shown to be for a bona fide business purpose. So the fact that there is just 2 layers of subsidiary would not really worry me too much. The fact that we are burying the ghost of round tripping is a more welcome.
That's very, very important clarity that you have given, Dinesh Kanabar, and also bona fide business, activity aspect, and more layers can be explained to the regulators. Cyril Shroff, do you have a view on the round tripping norms now, and do you think that this will spur more cross-border transactions and more ease of deal making?
So if I can supplement what Dinesh Bhai said, firstly, the most important thing is it's a big psychological step of removing the absolute bar or the taboo that was there on round tripping and actually bringing it into a more mainstream concept where it is allowed. So long as it is for you meet the conditions. And there's an interesting nuance also in the draft rules that were published last August. There was a connection with this being allowed so long as it was not undertaken to avoid or evade tax. And it's very significant that that has been dropped in the final rules. So it's an indication that they don't want to be subjective about it, because what is avoidance of tax and evasion of tax would have been a matter that would have been debated by experts all the way up to the Supreme Court. So they've taken away that subjectivity and made it more objective. If at all, you might have to go back to the RBI to get a clarification, but it's a bit more black and white in terms of what is allowed and not allowed. And then there's another interesting nuance. It talks of 2 layers of subsidiaries, but everything is not a subsidiary. You could have a minority stake as well. And I think it therefore opens up, it's what hits you in terms of 2 layers is only where it's a subsidiary. Whereas in the erstwhile FAQ-based regime, even 1 share was counted as round tripping. Now that regime has gone, and the standard now is much higher in terms of 2 layers of subsidiaries. So from a structuring point of view, this has opened up a lot of possibilities, and thankfully they stayed away from this very subjective area of it was not undertaken to avoid or evade tax, because God knows what that means.
That's right. Round tripping has been haunted by this whole tax evasion fear. Yes, Cyril Shroff.
No, nothing. You go ahead.
Yeah. So this is a very important clarity, and as both of you said, that this will evolve. At least the guidelines are there, and it is not a bad word anymore. That's a very big thing coming in, because in cross-border transactions,
activity is now a bright line test. So I think it's a much clearer. Maybe it's not completely unfuzzy, but there is much more clarity in terms of what are the no-go areas.
Right. And also, Cyril Shroff, on IFSC, we have had several discussions on the scope and how it's going to get bigger. There needs to be more participation. There has been a lot of flexibility and relaxations made in IFSC-led financial services, and of course with exclusion to bank as well as insurance. What's your view on that?
So building on what has been said already, I think the changes in this in relation to IFSC are significant. In what way? Firstly, I think it acknowledges expressly that it is like a foreign territory. Whereas erstwhile it was only IFSCA claiming that it is a foreign territory. Now India, so to speak, is recognizing that it is a foreign territory. As a result of which, it is possible to now think about it as if it's a separate kind of system, and mirror changes have been made both on the IFSCA side as well as on the India side, so to speak, creating a much more liberal framework. And because it is kind of an India thing, given it much more, for example, the 50% limit that applies for outbound investment, 50% of net worth doesn't apply if it is in IFSC. Even the round-tripping framework, so to speak, doesn't apply. The two-layer thing doesn't apply if it's an investment in IFSC as well. So I think it's a big boost, generally speaking, for IFSC. Financial centers such as this take decades to really come up. And unless this kind of very enabling and supportive policy frameworks are there, it becomes more challenging. So I think, more power to IFSCA on this. They have a long journey ahead, but things like this are going to certainly help it.
That's right. And Dinesh Kanabar, you have any more points to highlight which are broadly really game changers or add to what Cyril Shroff said? And I'm sure that both of you experts and industry at large are looking at certain clarifications, even though the document was quite detailed in many technicalities and housekeeping rules.
So first, just a quick short word on IFSC, because we have this concept which China has been trying to talk about, one country, two systems. In India, at least with IFSC, we have one country, two systems, and as Cyril said, more power to more such financial centers, and very welcome. A number of other changes, Nisha, as Cyril again nicely articulated earlier, that apart from sixes, there are those fours and ones and twos. So take, for example, we have always had this challenge that if you make an investment overseas and you want to write it off because of losses, whatever, you could not write it off without the Reserve Bank of India permission. Now you are granted an automatic approval to write it off. If you have to restructure a company, there are permissions which is granted automatically, that if there are 2 years of losses continuously, then you can write down the value of your investment in the overseas company. If it's not a 100% subsidiary and the value of the investment is more than $10 million, then you can get a valuer to come and certify what is the pro rata amount that you need to write off. Again, all of those very liberal sort of going back to say that yes, you can do things on your own. We trust you. You don't need to come to Reserve Bank for every single thing. So very welcome things. Your question as to what are the clarifications which one will need, and I think those will emerge. Nisha, I could put a few things, but it's too early. It's really when you start implementing, as you know, the regulatory power, the day-to-day regulations go to the authorized dealer. It's a question of what interpretation do authorized dealers take as you start working on transactions and you start interpreting. And that's where the need for a number of clarifications will come. As for example, the point which you are making, whether the overseas investing company would be regarded as financial services, not regarded. So some of those things will emerge over.
Yes, so some of them we live and learn. Cyril Shroff, very quickly, I have 10 seconds. Top 3 clarifications required. I know legal heads have many aspects to really delve into in this.
I have a long list and a short list. I'll go with the short list.
Yeah, top ones.
Clarifications required. Definition of control.
Yes.
Because a lot of consequences follow from how control is defined, because the ability to do or not do something.
Yes.
Second, definition of more clarity on definition between what are debt and non-debt instruments.
Yes.
For example, are optionally convertible instruments, warrants, redeemable debt. Where do they fall? Are they here or there?
Yes, and also made non-interest free. So that's a big one. Yes, and
then net worth, whether it's a group concept or an entity concept.
Yes.
And one could take care of you there is an entity concept, but that would defeat the purpose. I think the idea was that There will obviously have to be some rules as to aggregation
Yes.
in certain circumstances. But again, this is going to be a
These
big one.
three definitions, I totally agree. They have been on top of
And
my
one more, I think, what is
Yes.
prohibited sectors? They've added a new one on where linked to Indian currency. Were they trying to catch crypto? I don't know.
All right.
Otherwise, it goes too broad.
Right. And I would add to that the concept of strategic sector, probably how
Yes.
the industry really capitalizes on this, flexibility on the overall limit of, foreign investments that has been given to energy, renewable energy. That will be one thing that I will watch very carefully. But thanks so much, Cyril Shroff, as well as Dinesh Kanabar, for joining in with all your insights in this very, very game-changing new regulations on foreign investments. But we live and learn. It will evolve, and we learn as it is getting implemented and executed. With that, it's a wrap on Big Deal. Thanks so much for tuning in.
नहीं मूर्ति कोई फायदा नहीं अब